Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
This is Fergus Hodgson with the Gold Newsletter Podcast. Thanks so much for tuning in. I'm pleased it's the first one to go in 2020. I'm here in San Diego for the Global Monetary Issues in a Low Interest Rate World Conference being hosted by the Mercatus Center and the Institute for Humane Studies, both of George Mason University. And part of the readings for this event, which is a small group, maybe 40 or 50 different attendees, included a piece from a man named Scott Sumner. He's a senior fellow in monetary policy. He has a long bio, Professor Emeritus of Bentley University, which is in Boston. And he was also, well, are you currently a research fellow with the Independent Institute?
Yes, I am.
Okay, so the Independent Institute is another great think tank out in Oakland, California. But I'll just say, too, that the Mercatus Center, where he works, I guess, primarily, is in a very sharp and productive think tank in the D.C. area in Virginia. And I've been following them through my think tank work for a long time. And I asked Scott to speak with me today, or speak with the audience today, because there is a great deal of confusion about what the Federal Reserve does and does not do. And I must admit that this can infect me from time to time. I get confused too. And Scott has written an article, Should the Fed Pay Interest on Bank Reserves? And in it he discusses how the role of the Federal Reserve has evolved, particularly in the last decade, since 2008, so I guess 12 years to be precise. His concern is that there are myths about this, and he's seeking to clarify this and better explain what is going on. So what are those two myths, if you don't mind clarifying?
So one myth is the idea that low interest rates reflect an easy money policy. As is often the case with myths, there's a grain of truth in the sense that often when the Fed eases monetary policy, that day you see a drop in short-term interest rates. But over a longer and more meaningful period of time, often you get the opposite result. Let me just give you an example. We had a very expansionary monetary policy in the 60s and 1970s. As a result, inflation picked up. And as a result of the higher inflation, we actually had higher interest rates. So it's just as likely that an easy money policy can produce higher interest rates. And in a longer time horizon, it's actually more likely that high rates reflect easy money and low rates reflect a previously tight money policy that led to falling inflation or even deflation.
Yeah, this one, I must admit, was very counterintuitive to me too, because as you say, all else held equal, at the present moment in time, yes, a lower rate is easier monetary policy. However, of course, that brings on higher inflation than would otherwise be. And of course, we know that the nominal inflation rate includes both the real level, and the nominal interest rate includes the real and the inflation rate. So of course, we have to include both in what will come. So that is a very peculiar and counterintuitive result, but it makes sense when you consider the implications of what a lower rate means in the longer term. And the other one was about how we often think that the Fed is basically determining the federal funds rate, the interest rate that banks use to trade with between each other. And why is that not the case?
Well, I think it's a little misleading because it'd be more accurate to say the Fed is influencing interest rates by adjusting the supply and demand for money. Prior to 2008, they basically did this by adjusting the supply of money. They would move it to a position where market interest rates were at a level they desired. And this was not like price controls as we normally think of an artificial legal constraint on prices. It was actually the Fed influencing interest rates by directly controlling the supply of money. Now recently they've also added an additional tool called interest on reserves. That affects the demand for money. That also nudges market rates up and down. But it's very possible for the Fed to say lower short-term interest rates, and yet you see longer-term interest rates go up because of more bullish expectations about growth and inflation. So they don't really directly control interest rates in the sense that, say, New York City directly controls rents with an artificial rent ceiling, for instance.
there's a lot of maybe mystery or misunderstanding about how the Fed even gets involved with the federal funds rate. So how does the Federal actually increase the supply there if we're not talking about changing the rates on the bank reserves held with the Federal Reserve? How does the Fed actually change those, the Federal Reserve rates?
So what might happen is if the Fed injects more money or reserves into the banking system, banks temporarily have more reserves than they would like to hold, so they try to loan them out, and in order to do so they may reduce the interest rate on loans between banks, which is what the Fed funds rate is. It's an interbank loan rate. But again, over longer periods of time, this extra money, if it goes into the economy and spurs growth and inflation, can put upward pressure on interest rates. And we also have to keep in mind that the Fed is targeting inflation at about 2%. So the Fed is under a lot of pressure to adjust interest rates to a level that will adjust its interest rate target to a level that will lead to 2% inflation. So a lot of times I liken it to the boy that runs out in front of the parade, and it looks like he's leading the parade through the town, but he actually knows where the parade is going, and he just looks like he's directing it. To some extent, what the Fed is doing when they cut rates is they follow the market. In 2019, the market was putting downward pressure on interest rates, and in order to try to keep hitting their 2% inflation target, they felt they had to cut rates, cut their target rate, in order to prevent inflation from falling, perhaps even into deflation. So what looks like the Fed leading interest rates is actually often the Fed following interest rates with sort of defensive moves.
But just the actual process, how does the Fed inject or remove these funds?
Generally, it's done by purchasing assets such as treasury bonds or mortgage-backed securities. So when the Fed buys a treasury bond, they buy it with newly created money, and the person that sells the treasury bond to the Fed receives this money, deposits it in a bank, and it becomes part of bank reserves. Ultimately, in the long run, some of it goes out into circulation as currency, but initially it goes into the banking system as reserves.
The bit that I get confused about, though, is how the Fed will withdraw funds from circulation using that method.
So they would have to unwind that procedure. So the Fed could actually sell government bonds from their portfolio that they've accumulated. When they sell government bonds, the people that buy them pay the Fed money, and as the money goes to the Fed, it can be pulled out of circulation at that point. So it essentially reverses the original transaction where they injected the money by buying bonds. They remove the money by selling bonds.
Then one could go around in circles with this idea, and I don't want to get stuck on that because I've been told this approach for so many years in economics classes, and often I get it does get confusing. But okay, so now that we have these two myths, let's say, understood, that the Federal Reserve lowering interest rates does not necessarily mean in the long run that we have an expansionary monetary policy, because that will be generating inflation higher than otherwise would have been the case, and inflation naturally pushes up nominal rates, or the published rates of interest. On the other hand, we know that the Fed, at least traditionally, is not in control of the interest rate directly, but is rather controlling the supply of money traded, which therefore does impact the interest rate. And it was, at least until recent years, seeking to do so in such a way that would basically have the market clear and maintain inflation at around 2%. Is that a correct synopsis?
Yes, that's correct.
Okay, I'm trying to stay focused here. And what is your main or chief concern about the evolution of federal policy since 2008? Why is this so problematic, the fact that the Federal Reserve is now paying, even if only small rates of interest on bank reserves held with the Federal Reserve, where in the past, they were paid a rate of 0?
So my critique has been based on the idea that the Fed relies too much on interest rate targeting, that is, changes in interest rates as a way of implementing monetary policy. And because low interest rates can reflect either easy or tight money, to me it's kind of an unreliable tool. And the innovation in 2008 was to add a new tool of paying interest on bank reserves, With this tool, they sort of doubled down on a policy that I already thought was unwise. That is a very interest rate oriented approach to policy. And I would actually favor moving in the other direction, focusing more on the adjustments in the supply of money, the quantity of money, as a way of controlling variables like inflation and nominal GDP, and moving away from interest rates, which are a very ambiguous indicator. We don't really know when interest rates fall whether that's an easy money policy or a tight money policy. And when you have that kind of ambiguous policy indicator, it makes it much more difficult to hit your targets. For instance, in 2008, the Fed thought it had an expansionary monetary policy because it had cut rates modestly, but it turned out that monetary policy was actually getting more contractionary. If you look at the right indicators, like market inflation expectations were falling sharply in later part of 2008. The Fed ignored those market expectations and was complacent in its setting of interest rates at, say, 2% in the fall. And that turned out to be an excessively contractionary policy that made the recession much worse.
The Gold Newsletter podcast is proudly sponsored by the Discovery Group of Exploration and Development Companies. To learn more about our exceptional track record and exciting future, visit DiscoveryGroup.CA.
Hello and welcome back to our weekly interview with the Discovery Group, which is a proud sponsor of the Gold Newsletter podcast. As you know, each episode we interview one of the Discovery Group companies. I am Daniel Duarte, and today I have the pleasure of talking with Tom Martin, Director of Corporate Development at Ethos Gold. Tom, thank you for joining us yet again.
Thank you for having me, Daniel. Always a pleasure.
The last time you were on the show back in December, we discussed the Ligneris project in Quebec, as we have many times now. You were expecting essay results, right? But on December 17, you filed a technical report that is recommending two phases of exploration. Can you please go into detail?
Yeah, based on geophysics that were performed early last year, followed up with some groundwork in the late spring, there's two phases to our drilling. Phase one was completed just before Christmas. Mm-hmm. And as you mentioned, Daniel, those are the assays that we're awaiting. We should have them here in the next 4 to 6 weeks. And we're going to delay the second phase of drilling just by a couple of weeks until we get a few of the assays back to make sure that we're going after the key targets that we want for phase two of the drilling. Hopefully that will start, we think, probably first to second week of February. And we look forward to drilling probably another 3,000 to 5,000 meters of the Ligneris property.
I see. So let's switch for a moment to your other venture, Perky Rock. It's a copper-gold porphyry project in British Columbia. In early December, you also announced some exploration results. What did you find?
Well, we were very encouraged. We had quite an aggressive ground program we enlisted quite a few what we call copper porphyry specialists that are from down in the Nevada, Arizona region, and a couple of gentlemen from BC to help us on our preliminary groundwork, and we're very encouraged with the samples that we got. As the announcement relayed, we do believe we're sitting on a very strong copper porphyry system, and right now as we speak, we are formulating our drill program for this following 2020, identifying the targets based on the groundwork, but we are very pleased with the samplings that we got and some of the results that we got in 2019.
Speaking of this year, 2020 kicked off with encouraging news for gold prices, breaking out year highs. Do you think that will continue, and how is Ethos Gold planning to make the most out of this trend?
Well, like any exploration company, you get to a point where assays and results are your most important next steps. And I think that Ethos Gold is one of those companies. We're very excited about our Ligneris property, as I've mentioned to you earlier and in our previous call. We do have our Iron Point property down in Nevada that we're also very excited. Our CEO and VPX are down there right now formulating and planning our exploration program for this late spring there. Of course, for the whole industry, the strength of the gold price is important. It will help us. Everybody's hopefully stock prices will go up and we can raise money at less dilutive levels. That's obviously the goal with exploration companies. But results are the most important thing. And we think we're in a good position to have strong results from all three of our properties in 2020. That's Ligneris in Quebec, Iron Point in Nevada, and of course Perk Rocky here in BC. So hopefully, especially for our shareholders, that we can give them a nice bump in stock price and get some excitement in the Ethos stock.
Right. And finally, what are some ways that Ethos Gold is planning to reward shareholders this year?
Well, we hope to reward our faithful shareholders, and I would say they're faithful because we have a very good core group of investors, some that have been with Ethos since 2010. I've gotten to meet some of those shareholders this last year as I've been part of the company, and our CEO Craig Roberts and our VPX Joe Price are making very good decisions on the properties and projects that we hope to find resources in. So I hope to reward them for their patience and their faith in our board and our directors and our staff, that they've trusted us to make the good decisions, that these decisions come to fruition, and that there's going to be some resources found in all three of our projects.
Well, Tom, thank you so much for your time today and for updating us again on Ethos Gold and its opportunities.
Thank you, Daniel, and all the best to you in 2020.
In your paper, should the Fed pay interest on bank reserves? Just put a plug in there. You just name dropped in there, nominal GDP targeting. Why are you a fan of this alternative to straight inflation targeting? Because right now the Federal Reserve has a double or even a triple mandate to have low unemployment, low inflation, and moderate interest rates. I think that's the wording in its mandate. So basically a triple mandate. Why do you not favor, let's say, just a single inflation target?
Well, the two most important parts of the mandate are the low inflation and high employment. And nominal GDP is one variable that sort of picks up both of these policy goals. And I would argue that focusing on a single variable is more efficient than being distracted by two different variables, each of which are a very ambiguous indicator. For instance, in 2008, inflation temporarily spiked because of a sharp increase in oil prices. That made the Fed think that policy was perhaps a little too expansionary. But in fact, if you looked at nominal GDP, which is a better overall comprehensive view of the economy, we saw growth slowing in nominal GDP. And if the Fed had paid attention to that, they would have had a more expansionary policy in 2008, and the recession would not have been as deep. So just as interest rates are an ambiguous indicator, inflation can be affected either by demand shocks or supply shocks. The Fed really only needs to worry about inflation from demand shocks. They got distracted by supply side inflation in 2008, whereas nominal GDP is a more direct measure of what's going on with aggregate demand, and stabilizing nominal GDP will produce a more stable economy than you'd get from stabilizing inflation.
Pardon my lack of familiarity with this term, this nominal GDP targeting. Why would we focus on, are we focusing on a certain rate of growth to nominal GDP? What rate should that be? And of course, as we know, nominal GDP can be spiked by inflation because it is nominal as opposed to real. So I understand your logic that we want to just have one target and we don't want to be confused by external price shocks that really have nothing to do with the Federal Reserve policy. But why then is nominal GDP the most appropriate alternative?
Right, so if you have a price shock from like an oil price shock and you're targeting inflation, you have to sort of decrease non-oil prices to keep the overall level of inflation on target. So you're balancing out higher oil prices with lower non-oil prices. That's very destabilizing to the economy. On the other hand, if you're targeting nominal GDP, it sort of allows a little more flexibility. You can have inflation go up a little, real GDP go down a little, but not as much as real GDP would fall if you're targeting inflation. So, yeah, it's true that nominal GDP includes real GDP growth and inflation. If you add up real GDP growth and inflation, you get nominal growth. But what you get is each acts as sort of a shock absorber under nominal GDP targeting. So when one spikes a little, the other can fall a little to pick up the slack. On the other hand, if you're targeting just inflation and you're trying to hold that at 2% and there's a supply shock, then you have to dramatically reduce real output and prices in other sectors to keep inflation on target. As far as the exact number, people have proposed, say, about 4% a year growth in nominal GDP as a target. Since the labor force grows a little bit, that would mean maybe the average person would get pay increase of 3 or 3.5% a year, something like that, as a reasonable target for nominal GDP growth.
But are you talking about a purely automated policy or one that still has discretionary oversight?
So I'm personally opposed to a discretionary policy. I would like a system where the market basically determines the money supply and interest rates. In my proposal, essentially whatever monetary instrument, say the money supply or interest rates, would be set at a level where the market expected on-target growth. So if your target was 4% nominal GDP growth, you should have monetary policy set at a position where nominal GDP futures contracts in equilibrium show an expectation of 4% growth. And that would take away the discretion from Fed officials, because I believe the market often sees shocks hitting the economy before the Fed, and the market will more quickly pick up when there's a need for either higher or lower interest rates or money supply. And I think it's going to lead to a more efficient monetary policy than relying on the discretion of Fed officials.
I've heard this too, and the Taylor rule is one that's been very prominent as basically removing individual or personal discretion from monetary policy and just having a simple formulaic or algorithmic approach. I guess there's a key question here, and you mentioned even in your talk, I think it was you, that the United States has not really led the way in monetary policy innovation here. Have any nations actually implemented a straight algorithmic or automated monetary policy?
Not really, except if you view like the gold standard in that light. There's a sense in which it's automatic. But under modern fiat money systems, they've generally been discretionary. In my view, proposals like the Taylor rule are a little bit problematic because the Taylor rule assumes an equilibrium interest rate that's stable over time, and in fact it might change. So the reason I prefer a market-directed monetary policy is when there are fundamental changes in the economy, the market will adjust its formula, if you will, for monetary policy in such a way that the market thinks is optimal. Whereas I think any sort of mechanistic equation for setting interest rates or money supply based on a computer model will be appropriate at some times, but might be wildly inappropriate as the economy evolves and changes over time. In contrast, the market approach is going to sort of adjust automatically as economic conditions change. So for instance, if the market sees that the natural rate of interest is lower than it was before, then a market policy will automatically set rates lower. And in 2019, I think the Fed started to move in this direction. The traditional policy rules like the Taylor rule would not have called for an interest rate cut in 2019. The Fed cut rates 3 times, and in my view, in doing so, prevented a recession that would have occurred under the old regime. Instead, the Fed looked at market indicators that were signaling there was a real danger of recession, and the markets were telling the Fed that even though rates seem low, given the booming economy, they're not low enough. The Fed cut them further, and as a result, we're not having a recession now that I think we would have had if we had followed a more mechanical formula for adjusting monetary policy.
This is maybe getting a little bit off the topic, but when the Fed did make those 3 cuts, were the officials simply delaying the inevitable?
No, I think they were responding to an actual fall in the equilibrium interest rate. I think we're in a new environment where the old rules of thumbs about interest rates just don't apply. We have a booming economy, surprisingly low unemployment, and yet the U.S. and the rest of the world doesn't seem able to support the sort of higher interest rates that we had in the past for a variety of reasons. And that's why I think it's important to have a policy rule that is flexible And I believe only a market-oriented rule can give you that, because only markets are able to process vast amounts of information in an efficient way and come up with a judgment as to what sort of policy setting is appropriate. I don't think any computer model can do that. So again, I think the markets were telling the Fed that money was too tight at the beginning of 2019, and fortunately the Fed started paying more attention to markets than they had back in 2008.
We've been speaking with Scott Sumner of the Mercatus Center, and aside from just the Mercatus Center website, mercatus.org, do you have any other books or places you recommend for people to better understand this nominal GDP targeting and other approaches to central bank policy which are not purely private or not the entirely competitive currencies, but are perhaps more responsive to market signals?
So David Beckworth has a paper at the Mercatus Center that you can access online that really makes the case for why nominal GDP targeting is a good idea. I have a paper at Mercatus that specifically addresses the issue of why markets should be the guide to monetary policy rather than the discretion of Fed officials. And so you can sort of Google those two papers, and that would give you, I think, some insights into our ideas. I'm currently working on a book, but unfortunately it's a slow process and it won't come out probably for about a year, so that's what I would point to.
Thank you, Scott. And you can find those links. Our great editor, Daniel, will have those up on goldnewsletter.com/podcast with the show notes. Thanks for tuning in.